No, we will not help the stock markets. Central Bank Chairman Jerome Powell has let it be known that he will offer no help or support to the markets. This is despite a lot of pressure from US President Donald Trump, who is urging the Federal Reserve to cut interest rates. Trump has spared no criticism whatsoever. He called him a fool and said that everything he does is too late. But even if the Fed were to succumb to that pressure, it wouldn't necessarily lead to lower borrowing costs for consumers and a boost in stocks. The current escalation is not only hurting stock markets, but could also trigger the effect of much higher and longer-held high interest rates. Stocks may have moved higher in recent days, up 4.6% in the past week, but still high government bond values that are closely tied to inflation and rates still pose a threat. What can we expect from the central bank, and what should we prepare for? President Donald Trump is urging the Federal Reserve to lower interest rates, but even if the Fed were to succumb to this pressure, it would not necessarily lead to lower borrowing costs for consumers. In fact, economists say Trump's continued attacks on Fed Chairman Jerome Powell and his tariff policy could keep long-term interest rates, which are important to consumers and businesses, even higher than they would otherwise be. A less independent Fed could lead to higher borrowing costs over time, as investors worry that inflation could spike in the future. As a result, Treasury bonds are still at high levels. Trump has repeatedly called on Powell in recent days to lower the short-term interest rate, which the central bank controls. The Fed typically lowers that rate during an economic downturn to encourage more borrowing and spending, and raises it to cool the economy and fight inflation when prices are rising. But long-term interest rates, such as mortgages, car loans, and credit cards, are largely determined by market influences. Concerns in recent weeks that Trump's sweeping tariffs could boost inflation, along with the administration's threats to the Fed's independence, have led markets to push those long-term rates higher. It is unclear whether the Fed can fully reverse these trends on its own. It is not automatically true that if the Fed were to lower rates that we would see a measurable decline in long-term interest rates. But what is definitely measurable is the number of subscribers to our channel, so join in too so you don't miss any more interesting videos from the world of stock markets. Trump on Wednesday and again on Thursday called on Powell to cut the Fed's short-term rates, telling reporters that the chairman is making a mistake by not doing so. Last week, Trump even hinted that he might fire Powell. Stock markets fell sharply in response, with the yield on the 10-year Treasury note rising and the dollar falling, an unusual combination that suggests investors are selling most U.S. assets. However, markets erased those losses after Trump said on Tuesday that he had no intention of firing the Fed chairman. Threatening the central bank does not reassure markets. Rather, it scares them. The result is often the exact opposite of what any administration would want. That means higher rates, weaker confidence in the dollar, and more market confusion. Since early March, when Trump began imposing tariffs on Canada and Mexico, the yield on 10-year Treasury bonds has risen from 4.15% to 4.6%. It is currently around 4.3%. This yield is the benchmark for interest rates on mortgages and other loans. They have risen during this time, from 6.6% to 6.8%. While Trump says he is negotiating tariffs with many countries, most economists expect some level of tariffs to remain in place for at least all of this year, including his 10% tariff on almost all imports. So the trade war certainly won't disappear overnight. Investors at 𝗕𝗂𝗶ecie don't mind though. Thanks to the fair price index, they know exactly which stocks are below their fair price based on DCF and relative valuation due to the current situation, and can thus make the most of the situation. All the additional data available in the detail of each stock, which thousands of investors have used, will also help for their own thorough analysis. So check it out too and pick stocks like a pro. The 10-year yield fell on Thursday and Friday, as two Federal Reserve officials said a rate cut is possible as early as this summer, provided the economy weakens and unemployment rises. In total, Wall Street is counting on 3 possible rate cuts this year. If the Fed cuts rates too soon now, yields could move in the opposite direction. Such a move would call into question the central bank's credibility. Trump said in a social media post last week that there is virtually no inflation, and therefore, the Fed should cut its key rate from its current level of 4.3%. Many economists expect the central bank to do so later this year. However, Powell stressed that the central bank wants to assess the impact of Trump's policies before taking any action, and needs to be 100% sure it is the right move. Inflation has been falling in recent months and fell to 2.4% in March, the lowest level since last September. This was probably the last time we saw inflation numbers fall for a while. The key issue for the Fed is that the economy is very different now than it was during Trump's first term. Back then, inflation was actually below the Fed's 2% target. Now, however, rates will almost certainly rise in the coming months, at least temporarily. Still, once there are clear signs of a deteriorating economy, such as rising unemployment, the Fed will cut rates regardless of what Trump does. A rate cut is likely to be a positive signal to the markets. Stocks could see at least some growth later this year. There's a new video coming out on Wednesday, so be sure to subscribe so you don't miss it. Do you think the markets can get into the green this year, or will they continue to fall? You can go discuss this with investors on 𝗕𝗂𝗶ecie, or we can discuss in the comments. Good luck to your investments.